Welcome to the latest episode of Quest for Twice. Today I'm going to do a deep dive on my core holding, Atkore. But first, since I did a deep dive about the Mercado Libre 2 weeks ago, its stock price had a deep dive, unfortunately, and dropped by about 30% from 2 weeks ago. So what's going on? So this chart compares the Mercado Libre's stock price against the ARK ETF. ARK ETF is a popular ETF investing in growth stocks. So we can see that the price movement in 2021 have been very correlated. Occasionally, the Mercado Libre had a larger volatility as an individual stock compared to an ETF, but their trend is similar. And in November, ARK ETF had a significant price decline by about 20% in a similar trend as Mercado Libre. So there is really no company-specific news about Mercado Libre. I believe the recent decline in November is due to the general fear about the growth stocks, and that's reflected in the ARK ETF significant decline also. So let me switch topic, start my deep dive about Atkore. So as this chart shown that I bought Atkore stock between August and January 2021. So why am I doing a deep dive now? That's because I invested about 10 months of my former salary in this single company stock. And this stock price chart shows that the stock price has significantly increased over the last 15 months. So due to the investment success, now Atkore stock becomes 40% of my total investment portfolio. So obviously, it's a very large percentage. So I need to manage the concentration risk by periodic business review, make sure that the company and its stock price are still in good shape. And I'm also making preparation for my portfolio planning for the next year. So this slide shows the key products by Atkore. Broadly speaking, it has two segments. One is electrical products, including cable systems and cable tray systems, as well as conduit and fittings. The other segment is mechanical products, including security products, mechanical tubes, traffic products, construction services, and framing systems. Its electrical segment is much larger than the mechanical product segment. So later on, I'm going to have numbers to show the revenue and the EBITDA broken down between the two segments. So for its fiscal year 2021 revenue, the company provided the contribution from the different end markets. So the biggest contribution came from the non-residential new construction. That's about 33% of its revenue. And the repair remodel is about 15%. And the residential market contributed about 20%. The OEM includes products sold to solar power developers. It's about 15%, and the international and other segments has contributed for about 10% and 7% in 2021. The previous slide shows that Atkore makes a lot of different products. So that introduces complexity because many of those products are needed for a single construction project. So Atkore delivers value by managing that complexity for its customers. Its motto is one order, one delivery, one invoice. That means its customer can place a single order to get all the parts it need for electrical constructions. And Atkore will make one delivery to get all the products that the contractor needs and issue one invoice for all its delivery. So that's a significant simplicity considering the complexity and the number of product offering Atkore makes. On top of that, there is also geographic complexity because if a customer is in one state, if it needs to order products from several different vendors that are located in different locations, then that's a geographic complexity. For Atkore, it takes away that complexity because it has a national footprint, including 52 facilities for its electric segment and 19 facilities for safety and infrastructure segment. So its facilities are shown on this map as different dots. The dark blue and the light blue are the manufacturing facilities. And we can see that Atkore has a national footprint. So I believe Atkore has a narrow moat that's derived from managing the complex supply chain for the electrical segment. Its customers are usually construction contractors. They care more about the schedule versus cost for the products Atkore make because those products usually don't cost that much to begin with. However, for a project, if one component is missing, not delivered in time, it may hold up the entire project. So it's very important for the contractors to make sure all the parts it need will be delivered in time. And that's regardless where the project location is across the United States. So working with a supplier with a national footprint and it's not sensitive to the job location, introduce a lot of simplicity and reduce the schedule risk for the construction contractors. As a result, its customers are willing to pay a price premium for the products. Another consideration is for the conduits and many other pipes and components, they are bulky. So they would incur high shipping cost. Um, for Atkore has a national footprint. It can optimize the delivery by shipping from its local or regional manufacturing and distribution centers. That lowers shipment cost and give its moat compared to a supplier that has more limited footprint. And by the same token, the Asian manufacturers are not really a threat because even if they can deliver a lower cost, but their products have to be shipped by ocean freighters and delivered through the ports, then have to be shipped maybe across a long distance to reach inland construction sites. For these reasons, I do believe Atkore has a narrow moat. The reason I think it's narrow, not wide, is because it's not that difficult to make its products. Those are fittings and tubes and trays. So the price premium has to be limited. Otherwise, the contractors will start to pay more attention and balance the schedule and convenience versus very high price premium Atkore may charge. So I don't believe its moat is very wide. Now it's time to update my risk analysis. In August of last year, I did a mini deep dive about the Atkore stock. So I listed the short-term and the long-term risks to that company. On the short-term side, the first one is about the liquidity. And it's no longer a concern at this point, given how much cash Atkore has generated. Next one, Atkore business is tied to non-residential construction, and its revenue forecast back then was a 5% decline year on year. But I noted the U.S. housing permits were at a decade high, which may lead to increased non-residential construction later. So what happened was actually U.S. housing permits were at decade high, and that was actually much stronger than expected, which resulted additional demand exceeding supply, at least related to the products Atkore makes. And that in turn resulted in record sales and margin for Atkore. One threat I noted back then was Democrats may control both the White House and Congress and raise corporate tax. It turns out Democrats indeed won the senator runoff in Georgia in January of this year and had total control of both White House and Congress. However, the anticipated tax rate increase is still being discussed, has not happened yet. So on the long term, I mentioned that if cheap imports are used as substitutes, then Atkore's pricing power and margin will decline. I did mention that it has integrated supply chain from design to delivery and provides a one-stop shop and distributed the manufacturing and the distribution so that may provide some moat. Now, with 1 year behind owning the stock, I'm pretty confident to say that Atkore does have a narrow moat, and overseas suppliers are not really a threat. The second long-term threat I mentioned was the company generates a lot of cash without paying dividend, and the management pursues growth through M&A. And if the cash was misused for acquisitions, then value would be destroyed. So I'm going to talk about it in a subsequent slide. To me, that threat turns out not to be an issue. The last one was an opportunity identified because I was correct to say that the only way to decarbonize the economy is to electrify cars and buildings. That will create a long-term demand. And that is indeed happening. So I would conclude that my risk analysis from 1 year ago was pretty good. Now with a few additional updates. The first one is, as I mentioned, the U.S. residential market has been much stronger than expected. However, a price war may break out if all the suppliers are adding new capacities and they come online While the housing market cools, then the demand falls, then there will be a mismatch, and the suppliers may use a price war to sell their products, and that will severely depress revenue and margin. So that is a threat. Don't know if that will happen, but it's something to watch out for. An additional opportunity was the infrastructure bill has been signed into law, and that will create the additional demand, including EV charging facilities, and that will create the additional demand for Atkore's products. Additionally, the non-residential construction enjoys some long-term tailwind, including hospitals, warehouses, and data centers. Those will grow above a historical trend just because of people are aging and development of e-commerce and the need for warehouses, as well as digital transformation in our society will naturally lead to more data centers. This table quantifies the supply versus demand picture I discussed earlier. So I listed the revenue in the past 5 quarters, as well as the EBITDA margins. So because of the supply and the demand imbalance, Atkore enjoyed EBITDA growth for 5 quarters in a row. That's really captured in the electrical segment, with significant growth in both margin and sales. So the mechanical segment is about a third of the electrical segment revenue. What's interesting there is the EBITDA margin for that segment. So in Q4 2020, its margin was about 13%. Then it had a decline for about 3 quarters. But in the latest quarter, its EBITDA margin has recovered to the Q4 of 2020. The reason behind this margin round trip was because of the material inflation we have all heard about in the economy. The mechanical segment uses a lot of steel and other metal raw material as inputs. So because of the material inflation, it couldn't raise the price fast enough to offset the input cost increase. As a result, its margin suffered. Now, the margin has recovered. That shows me that its price increase has caught up with the input cost increase. So, as long as the input cost holds steady or even decline, then that segment will start to make a good, significant contribution to overall company's EBITDA. So that's great news. Another important aspect to point out from this table are the guidance and the outlook given by the management. So in Q4 2020, management gave an outlook of 350 million EBITDA in fiscal year 2021. And that outlook was raised significantly from one quarter to the next as the year went by. What's even more interesting is the management also gave an outlook for fiscal year 2022. And that outlook has also been raised from one quarter to the next. Now, in the latest quarter, the management gave a guidance of Q1 2022 EBITDA will come in around 240 million And that's less than the latest quarter. However, if we put it in the historical context, that's still a very big number. And it also implies a ongoing steady state EBITDA of 150 million per quarter beyond the Q1 2022. As we can see from this table, management tends to be conservative when they gave guidance on future EBITDA. So the implied 150 million per quarter steady state EBITDA is likely an underestimate. Currently, there is still more demand than supply, and that creates a high sales and margin for Atkore. Management thinks that will normalize, which makes sense, but the timing is uncertain. So they basically just assume that the normalization will happen after Q1 2022. And if it goes on longer than that, then the outlook will be raised. Now, I want to say a few words about the Atkore management. So as I alluded in the previous slide, the management had a track record of under-promise and over-deliver. So put it in the context of year 2021, that's really impressive because there were a lot of COVID restrictions from January to July of this year. And then there were labor and material shortages. But all those operational issues did not really impact Atkore in terms of business performance. So I also owned some other companies, and so I could see the difference in terms of Atkore management had a very strong ability to deliver what they promised and to exceed what they have promised. To me, that's a very good trait and makes me have a lot more faith and trust in Atkore management. Another important consideration for management is how well they make investment. Because as I alluded earlier, if the company generates a lot of cash, but the cash is wasted by overpaying mergers and acquisitions, then that will destroy the value. So this chart shows the history of Atkore acquire, integrate, and manage additional acquisitions. So I see a lot of acquisitions since 2013. And what was the result of those acquisitions? That can be actually measured by a metric called ROIC, return on invested capital. So what we see is after 2015, every year the ROIC has been over 10%. Over 10% is an indication of wise use of investment and also an indication of the moat of the company. So I would say the management has a track record of smart acquisitions, and I have faith in the management to wisely use its significant cash pile on hand and to increase future business and future EBITDA. Finally, I'm ready to review the valuation of the company. And it's very interesting to compare with what I prepared in August of last year when I made the initial purchase of that company stock. So back then, the stock price was $30 or less, and with the EV over EBITDA ratio about 6.9. And the EV is the Enterprise value stood at $2.3 billion with a manageable amount of debt. Fast forward by about 14 months. Now, with a significant price increase in its stock at about $110 per share, its market cap has more than tripled, and its enterprise value now is at 5.2 billion. So, is the company getting too overvalued? If we use the steady state $150 million per quarter EBITDA given by the management, then the EV over EBITDA is about 8.7. Keep in mind that the impact from infrastructure bill not included in the $150 million figure. And also, there are long-term multiple secular trends that should help company to grow its steady-state EBITDA, as I mentioned earlier and listed again on this slide. So is EV over EBITDA ratio of 8.7 inexpensive or expensive considering the growth potential? So we can compare with the two benchmark companies. They are both industrial players as well. One is Hubble, which will also benefit from energy transition and more expenditures on the grid upgrade. It has a 18 times EV over EBITDA ratio. Another player is Amazon, which makes automation products as well as some other home-related products. Its EV over EBITDA ratio is 14.5. So I would argue that at the current ratio of 8.7, Atkore stock is still undervalued. Yes, from that ratio alone, it's higher than 6.9 in August of last year. But its stock price increase has mostly been driven by the outstanding business performance and by significant elevation of future steady-state EBITDA potential. So finally, I pasted my original investment case. So Atkore, I believed it was a large player in a niche market. It's a leading manufacturer of electrical raceway for non-residential construction and renovation markets. It holds number one or number two positions in the US by sale in most of their products. It enjoys growth in both revenue and margin even before 2020. So I would say the original investment case is still valid. And the current valuation level of 8.7 EV over EBITDA ratio is still an undervaluation of its true business value. Now to wrap it up, as I mentioned earlier, 40% of my portfolio is in Atkore stock. That's not by design, that's just by the investment success related to the huge price run-up in the last 14 months. So I will have a really important decision to make in December about if I want to rebalance my portfolio, sell some of my Atkore stock and buying some other stocks. So I'm still thinking about this decision, and today's deep dive is building the foundation for me to make a decision in about 3 weeks. So stay tuned. Until next time, happy investing.